there's things that we can do, such as implementing RUBS, which is utility bill back, that the other owner either wasn't motivated to do or wasn't sophisticated enough to figure out, because it takes a little bit of, you have to understand how it works. You got to have the systems in place to be able to now all of a sudden bill back a partial, usage of your utilities to your tenants. But that right there creates a ton of additional revenue that goes against your expenses. So if you can get your expense ratio from, the 40% to 35% just by instituting RUBS, I mean, that's a phenomenal increase to your NOI that is going to translate into returns for investors.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio, episode number 181. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Let's get into the show. Today, my guest is Josh Welch. Josh is a former rocket scientist turned real estate investor. He's also the founder and managing principal of Three Pillars Capital Group based in Houston, Texas. And before we jump in with Josh, I want to remind you, if you like the show, we would love to hear from you. You can like, share, and subscribe to CREPN Radio. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, Commercial Real Estate Pro Network. And now I want to say welcome to Josh Welch. Josh Welch, welcome to CREPN Radio.
All right, Darren. Thank you. Appreciate it, and looking forward to being on the show.
Yeah, I'm looking forward to talking with you. Before we get going here, if you could share a little bit about your background. I mentioned you're a rocket scientist. I saw that somewhere. I think it was on the Three Pillars website. If you could share a little bit about your background and how you got into real estate.
Sure. So, like you had mentioned and introducing me, I rocket scientist is kind of a tongue-in-cheek thing. I mean, I'm an engineer by trade. I went to school for electrical engineering and got out of school and immediately went to work for a company, Lockheed Martin. A lot of you guys probably are familiar with that company. And so I worked for them, and I did very much, in fact, design missile navigation systems, which I guess makes me a rocket scientist, but neither here nor there. I kind of, really got the real estate bug. Didn't happen until a little bit later in my career. I started developing a portfolio of single family properties in Florida where I was living at the time. And I started realizing how you could scale into a portfolio and you could start small, manage a small size of properties and kind of really grow something with great momentum. And I realized though that the path to continue scaling at that rate with, buying single families or duplexes or whatever it is, wasn't really the engine that I was looking for. I needed something a little bit beefier. And that's kind of when I stumbled into multifamily. And, I would say it's probably about 3 years ago now is when the light bulb went off in my head that, hey, multifamily is really the path forward for me to continue growing a portfolio and getting the economies of scale and, the whole 9 yards. So I guess with that's kind of a very, top level overview of how I kind of got into multifamily.
Got it. So now, if I understand, you are based in Houston, right? And is that where your primary focus is?
Yeah, so we are based in Houston. The way that we like to look at it is we want to get really good at, really hone our craft in one market before we start diversifying ourselves and going into different markets. So we have a really good pulse by being here and being focused in Houston. First of all, it's the fourth largest city in the country. A lot of people don't know that. So there's still ample opportunity in the space that we deal in, which is Class C multifamily. So by really knowing our market well and knowing the submarkets and the micro trends that are on a very local level, we have an edge that a lot of competitors that might be from out of state don't necessarily have. And so, as we grow and continue to expand, at some point we will definitely be, going over borders and, state lines and things like that. But for right now, we're in Houston.
No, I tell you, I think there's a lot of benefit in focusing in on a market, and like you said, learning the nuances and the market and the sub-market. I think that's something that gets lost a lot of times as people, forget the micro markets in the market kind of thing. And speaking of that, I'm just kind of curious, are there any particular things you've seen in the last, you said, 3 years that you've been focused on that have shown, have been a bright spot or have kind of been a cautionary, beware kind of thing based on being focused on the market?
I mean, I guess a lot of it comes down to what, the demand that we see for our units. We see, I mean, that's really the best barometer is like, okay, if you have a sizable portfolio in kind of all in the area that you're in, and it's diversified to a certain extent, you can kind of get a pulse from the ground up to see, things are slowing down. And we don't really see that right now. In fact, we see, leasing demand and demand for our units, our repositioned products is higher than it's been since we started. It keeps getting higher and there's more pressure being put. But even more than that, I mean, the competition for new acquisitions, we do all of our acquisitions in-house. We actually have our own director of acquisitions. And he is, responsible for sourcing deals for us, basically with no broker involved. And even those deals are getting harder to find versus even they were a year ago. So we see, demand between other owner operators. The competition there is continuing to grow. Even with the whole debate about interest rates rising and what's that going to do to cap rates, that doesn't seem to have any bearing on people, the hunger that people have to continue buying property. So if anything, I still see it as, no matter what the stock market is doing, no matter what the pundits tell you on TV, what I am seeing in my market, especially in Houston, is that the demand is as great as it's ever been. So if anything, it's all full steam ahead.
No, that's great news. Not being totally familiar with Houston, I've driven through it. I think I-10 drives through it or near it. I remember.
It does. It cuts right through the center.
Yeah. Can you shed a little light? I know it's an energy focused market. What are the are there other major employers that are based there?
Sure. So, I mean, no doubt. I mean, it definitely is an energy city, and it was more correlated to oil, 40 years ago than it is today. Houston has very much diversified itself. There's the big retail sector. There's a lot of medical research that happens in Houston. There's more startup tech companies that are moving here. It's very much starting to, spread its wings and really expand into many different sectors. So you're still going to have a bit of a correlation on oil. I mean, that's not really going to go away. But to say that it was, it's solely correlated to oil as it was 4 years ago is no longer true. So for us, that means that we have a more diversified tenant base. We have tenants that have jobs from all different sectors of the economy, which is only good for us.
No, I would think so, and it's a port city too, is it not?
Yeah, it is. Yeah, there's a lot of port activity from the refineries for sure.
Okay, gotcha. Wanted to ask you a little bit about your team. You mentioned you mentioned one of the parties I think responsible for finding deals. Can you speak a little bit about the members of your team and the different jobs and that?
Yeah. I'm obviously at the head. I'm the managing principal of the firm and all the deals we sign on. I mean, our team really, it's made up of a handful of individuals, but I mean, at the core of it, it's myself, it's director of acquisition, director of operations. It's our ground staff that, we have a handful of property managers, maintenance teams, project manager. But I would say, our investors really are more involved in our deals than what you would see from most sponsors. We have key principals that we bring into a lot of our deals, and they might even be listening to the show. I'm not sure, but I wouldn't be surprised if I get a phone call later tonight saying, "Hey, I heard you on the Darren's podcast." So I'm looking forward to that phone call later today. But these guys help us out in tremendous ways. Key principals for us are someone that come onto our team, and they help us with certain operational facets of the deal. So, a deal that we just closed on, it was a 56 unit deal. It was about it's under $4 million price tag. We had a few key principles in that, and they're helping us do things like, design the signs, repositioning the property, working on things like branding, helping us with designing tenant communications and tenant events, working with contractors, getting labor set up for various, rehab components that we need done. And so the value to them is that, they're very much a part of the team and they're able to cut their teeth in a real deal. And the value for us is, we can delegate tasks. And so, our team, if you really look at it from that standpoint, I mean, we're 50 people. So it's been quite a growth of the organization. I'll say that much.
Sure. And when you mention the key principles you're bringing on, are they all participating on the general partner side, or are they limited in participating, or?
They come into the, some of them come into the GPS. It depends. It's case by case basis. It's at the end of the day, it's a relationship business. So there are some key principals who have in fact gone on to become the GP with us on other deals. So it just depends on the chemistry, a lot of it's chemistry and, kind of the drive that they have and kind of where they want to end up. I mean, do they want to be owner operators like us at the end of the day, or, are they content with, being involved, but, they don't want to have the 9 to 5, 24/7 sometimes, responsibility that comes with being an owner operator or being a sponsor.
Gotcha. So when you put together a property, I'm just kind of curious, when you are looking for investors, do you find that a lot of them are looking for more involved? I mean, you've kind of answered that in a way, but I guess it's something it's different from what I've heard. I'm just kind of curious. Are you finding people that they have money or are going to raise money and they want to be a part of it? Or is it more of a matter of you guys reaching out to them, I guess?
Well, I mean, we have our own, private network of investors here in Houston that we pretty much go to for a lot of our deals. We do have other guys that we've worked with in the past that have access to their own networks of capital, and we have different structuring with them for each deal. Every deal is sliced a different way. No one deal is like any other deal. So it really depends. But I would say that, we have our own, our own network of investors that we raise money from.
Gotcha. On just more of your strategy, your investment strategy, are you syndicating all of your deals? Is that the approach?
Yeah. So we're full syndication.
Okay. And you said C class value add, is that's the primary focus?
Mm-hmm. Yeah. So C class is really our bread and butter. I hear a lot of guys say in our space talk about how, the inventory of, class C value add is it keeps going down and down. Like, the old adage is like, you can't, well, how do you get a class C property? You take a class A and you wait 30 to 40 years. Right. So that's kind of the inside joke, but, that's a little bit of that is true though. I mean, we're seeing a lot, as these class C properties that are value add get gobbled up, the inventory is going down and down. So that's also creating a semi, artificial bubble, if you will, within the class C apartment space, which is what I find very interesting. So it's another reason why we really strive to keep all of our acquisitions in-house and minimize competition, because, the more people you have competing for the same number of deals, well, obviously supply and demand, the price is going to go up. So.
Right. No, it is interesting. I know I look around and see all the cranes. I'm based out here in Portland, Oregon. Mm-hmm. And I know the cost of new construction is, it's huge compared to, even though there's competition in the Class C properties, still the cost of a new property is significantly greater. And I think, when you weigh that, the cost to develop as opposed to if you can acquire a property and improve it, it still seems like it makes a lot more sense. Mm-hmm. Can you speak a little bit to the level of value add that you guys have engaged in?
Yeah, so we've done quite a bit. Like I said before, every project is different, even from the structure on the front end to the actual components of the rehab that you do. So we've done rehabs as simple as cosmetic work where, it's been mismanaged by management for a number of years, and there's a lot of deferred maintenance. And if you just go in and take care of the ACs that need to be replaced, and some of the sidewalks that need to be repaved, or even just pressure wash, you'd be amazed at what pressure washing a concrete surface can do to bring the life out of it, right? Things like that, the cosmetic type stuff, all the way to full guts, like the plumbing is just falling out of the ceiling, and you have to replace the whole thing. So it really depends, but I would say, we really strive to do, new lighting and paint is kind of one of our biggest things we try to do, because that makes a huge difference when you're going to look for curb appeal and what is going to wow a future resident. Flooring also makes a huge difference. We really emphasize putting good looking flooring in versus the old, linoleum tile that you sometimes see, or even the old peel and stick vinyl tile that we find, or even carpet, right? Carpet is going away. So, I mean, can you still get away with it? Sure. But, with everything that we're seeing is everything's moving to vinyl tile, the luxury vinyl plank stuff that's really, if you want to get the latest and greatest and the tenant who's going to pay the most dollar, you got to start doing the flooring. I mean, that's probably one of the biggest things I've noticed. Right.
No, it is definitely a trendy thing right now, and it looks good. And I think from a landlord standpoint, what I've found is the durable, easy to turn, and you get the hard surface. You don't have the retained odors or anything like that from with the carpet. So I'm a big fan of the LVP there.
Yeah.
Let me ask you a question based on the value add acquisition thing. When you found a property, it fits your model. How are you accounting for your value add cost? Do you have in-house construction people, or do you get all your bids from subs, or just kind of a?
Yeah, so our management company is Green Line Management, and that serves solely to manage our properties. And so we do have most of that in-house. I mean, there's a few things that we'll contract out, like, installing new signs in the building or roofing, but most of the, flooring, painting, your basic rehab to turnover unit, those are things that we would all do in-house.
Gotcha. Let's see. I was going to ask you, you mentioned the interest rates. I'm curious, you made it sound like you're not seeing any significance of that. Is it, is there any hint of anything, any of the banks you're talking to, or any of the, investors, or is it pricing? Are you seeing any of the pricing starting to maybe soften based on concern of higher interest rates?
Yeah, I think the interest rate is, again, nobody has a crystal ball, so everything I'm about to say is conjecture. But, from what I'm seeing is, there's so much debt money out there, way more than there was in the multifamily space. Everybody says, oh, how is it different now than it was back in the 80s when you had interest rates in the teens, And the difference is there's a lot more debt that's looking for home than you had back then. A lot more money that's okay with being put into multifamily, which is quote unquote considered risky. So now that money is okay with going into multifamily, you have more competition. So you have, banks that are willing to take a smaller spread, even with the rising interest rates. So if their margin was, 450 basis points a year ago, and now their spread's 300 basis points or 200, they'll still take it because they need the business so badly to put their money to work, basically. So that's what I'm seeing. I mean, now, of course, if interest rates skyrocket and you're back up in the 6s, 7s, 8s, of course, then, you're going to see some pressure on asset prices. But I mean, really, unless that happens and, interest rates have cooled off again, I still think you're seeing very healthy demand for multifamily, and cap rates are going to stay right where they are.
Right. Now, it is a kind of an interesting time, and I would say somewhat uncharted waters based on just like you mentioned, the capital out there that's looking for return. I meant to ask you another question, just backing up on the properties you guys seek out. The criteria you've mentioned, or we've discussed, kind of a C-class value add kind of thing. But is there any other kind of like a unit count or other criteria that you guys have found really, speaks to your sweet spot?
Yeah. So for us, it's really about, since we do manage in-house, a lot of what we look for is mismanagement, because that's a lot of the time where you're going to find most of your opportunity. I mean, getting a rent increase is one thing, but finding a property that has pure hidden potential because it's been mismanaged is what is a lot of times is hard to gauge. It's hard to look at a T12 and say, oh, look at how poorly this thing's been mismanaged. Now there's clues and there's things that will scream at you on paper that, hey, something's wrong here. But at the end of the day, there's a lot of value that can be derived from better managing the property. One of the best examples I can give you is probably a property that's an all bills paid property. You see a lot of those down here in Houston. A lot of these owners that we run into, some of them it's been in the family for, over a decade, or, they're sitting so well on it that they're not motivated to really try to make the property perform better because their debt is so low on it or whatever it is, versus, we come in there and we're the new owners. There's things that we can do, such as implementing RUBS, which is utility bill back, that the other owner either wasn't motivated to do or wasn't sophisticated enough to figure out, because it takes a little bit of, you have to understand how it works. You got to have the systems in place to be able to now all of a sudden bill back a partial, usage of your utilities to your tenants. But that right there creates a ton of additional revenue that goes against your expenses. So if you can get your expense ratio from, the 40% to 35% just by instituting RUBS, I mean, that's a phenomenal increase to your NOI that is going to translate into returns for investors. So that's what I think would be the biggest thing we look for is mismanaged properties, even more so than rent bump. Sure, obviously I want a rent bump, but I'm looking for mismanagement.
No, I hear you. If you are able to find the under rented and fully, like you said, the full pay property, that seems like an easy turn on that kind of thing. What are you seeing as far as a cap rate on in the Houston C-class multifamily? What?
Yeah, I mean, we're seeing cap rates into the 5s now. I mean, again, it depends on how much competition you have, because the more that someone wants to pay for it, I mean, it's a very simple equation. The lower the cap rate is going to be. But we really fight to still try to get things in the high 6s and the low 7s. Again, they're harder and harder to find. But it also goes back to how you operate it. I mean, I've seen properties where you look at, if you take the T12 at face value, and you say, okay, well, this guy's operating it at a 5 cap. It doesn't look like a great deal. But then I look at it and I say, well, this expense doesn't apply to us, or we can get this done for cheaper, or historically speaking, when we operate something, we can get more income here, right? All of a sudden, it doesn't take a whole lot to get something to move from a 5 to a 6 or 6.5 if you can run it better and more efficiently. So, depending on who the operator is, yes, you can still see 6s and 7s. But I would say 5 to 7 is the range.
Gotcha. Curious on properties that you've looked at. Is there anything that you were originally excited about that you walked away from that you could talk about?
Yeah, actually, there was a deal that we looked at in over the summer in July. It was 100 and I can't remember. I think it was 120-ish units. I don't remember the exact count, but it would have been a portfolio play for us. It was 2 properties that were located right across the street from each other. And we got there, and we had already done a lot of kind of marketing and promoting within our own internal network about it. We did all the underwriting. The numbers made phenomenal sense. Great deal, tons of upside. And then we got there, and one thing we always do when we have an inspection day and we're doing our due diligence is we get plumbers, electricians, roofers, anything that we know could be the biggest bullet that could get you later. We try to get that figured out on day one so that we don't have to sit there after we've already taken under contract 45 days. And, oh, by the way, the whole roof needs replaced. It's going to cost $500,000,
right.
Gulp. Right.
Mm-hmm.
So we actually got a plumber out there that we've used over and over again who does really good work. And he came in there and he, first thing I had him do was camera the lines. And we, after seeing what was going on in the property, unfortunately, we discovered that the amount of work that needed to get the plumbing so that it was actually functional and you didn't have units that were down all over the place. I mean, we're talking, it was like $200,000 to $300,000 of excavation for plumbing. And And as soon as we added that, plus all the roofs needed to be replaced, we didn't anticipate that. So all of a sudden, we've totally blown through most of our budget, and all we've done is fix 2 things. So that right there totally killed the deal. We were bummed, but I think had we gone through with it, not only would we have to go raise more money, but our investors would be asking us, why did you get into this deal in the first place? You should have done due diligence. So yeah, that was a tough pill to swallow, but I'd rather have that and be a little sore than by falling down than be down out for the count. You know what I mean?
Yeah. No, I think it's been said and probably holds true that some of the best deals are the best. Are the ones you didn't do based on what could have happened, kind of thing.
Mm-hmm. Mm-hmm.
Let me ask you this: you've been doing this a few years now. Is there something that you can point to that's gotten easier?
I would say, when it comes to especially when you're starting out, I mean, there's so many variables you have to consider when you're looking at it's a deal. Is this a good deal? Is it not a good deal? You're going to have a million people tell you it's not a good deal. You're going to have a million people say, oh, this is a great deal. And it's hard to kind of listen, find that inner voice. And I think that we're at the point now that what's gotten easier is that because we've been through so many transactions now, and we've said no to the one I just mentioned, right? And a couple others, that I know pretty quickly if something's even worth more than a 10-minute glance versus, starting out, you might take you an hour to get to that point or 2 hours, right? Going through your underwriting. And so I find I'm becoming a lot more efficient underwriting and looking at a deal and within a first pass. Is this even worth any more of my time? And so that's something that you really only get by doing and being boots in the ground and really understanding the mechanics of how everything works, not just from an Excel spreadsheet, but getting your hands dirty and running these properties.
No, that's great. Great input there. Experience gives you that.
Mm-hmm.
I got a question here for you. It's kind of being an insurance broker, like to ask people about risk, and it's not necessarily directed at insurance risk, but I want to ask you, what do you see is your biggest risk that you face?
I think the biggest risk I face, this kind of ties into what I was saying earlier, is that I think the biggest risk is thinking or pretending that you have a crystal ball and knowing and thinking that the market is topped out, and then letting that turn into fear of buying anymore or continuing to grow your business model, which for us is acquiring property and growing a portfolio. I get asked almost weekly now, well, don't you think the market's too hot and we're at a ceiling? I'm like, we could be. But, people were saying that, 3 years ago, and here we are, and we're higher than we were then. So it's like, you can always play that game where, things seem too hot. I'm just going to go wait it out. Well, you could be waiting it out for the next 10 years. So the question is, do you want to wait it out and let 10 years pass you by? Or do you want to take a calculated risk now and make sure as long as the deal makes sense and the numbers make sense and you can run it like you need to, then everything is fine. So I think the biggest risk actually is letting that fear overrun you of thinking that you know better than the market, and nobody knows where the market's going, right? Nobody knows, but I think letting that turn into fear and then turning into inaction, I think is the biggest risk, at least for me in our company.
No, I think there's a lot of wisdom in that. Everybody uses, and I've heard it said, and I think that everybody's looking to the last cycle to try and predict the next cycle. But there was somebody I was listening to, kind of a salty investor that said, we learn something new in every cycle. And so I think you're spot on with that, is that, you take the information and you make an educated decision. And, as long as you're buying to your criteria and you're buying on, not on or you're buying on cash flow and as opposed to the what if the market does this or that kind of thing, it sounds like you're in good shape. Josh, I want to be respectful of your time. I appreciate you taking the time to do this. I've enjoyed it. Before we wrap up, where can the listeners go if they'd like to learn more and connect with you?
Sure. So they can go to our website. It's 3pillarscapitalgroup.com. That's 3 is spelled out. So 3pillarscapitalgroup.com. You can read all about us, acquisitions, our team, And if anybody has a question or wants to know more about us, feel free to reach out to us on the contact page.
Got it. Josh, I want to say thanks again for taking the time to talk. I've enjoyed it, and wish you all the best.
Likewise. Thanks, Darren. Appreciate it. Have a good one.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.